ignoring something or losing something. So we will all leave our myths and assumptions about this stock market or equity market. Now, I welcome Deepak Ladda, Chairman of the branch. I welcome Saran Kumar Uppalapati, Sikasa Co-Chairman, and other senior members and friends who joined on time. So I can only say, anyhow, Saran is going to introduce the speaker today. Now I will tell with which is not there in the profile. He is a good friend of mine, and he also attended UPSC interview along with me. Also, he's a speaker. No, he's not a speaker. He's a faculty to our AP DGP cadre IPS officer Dwaraka Thirumal Rao also, because he is chairman in APSRTC. So with a small brief introduction, I request Saran Kumar Uppalapati, Sikasa co-chairman, to introduce formally today's speaker. Thank you.
Yeah, thank you, Secretary sir. In fact, Trashu is also a good friend of mine. Let me take the privilege to introduce Trashu Talatam. He has qualified CA in the year 2012 and ICWA in 2011. He has worked with India conglomerates like Tata Group, L&T at various positions. He has closely worked with senior leadership in the areas of strategic business management, strategic business development, process automation, project planning, transaction advisory, treasury, investment management, and so on. He has completed various studies on equity research. Right now, he is managing funds of government trusts apart from his own portfolio management services. His wife, Sri Sai Sahiti, is a full-time trader. He consistently strives for learning in the areas of equity markets. With this brief profile, I put before all of you the speaker for today's session, Mr. Trashu. Over to you, Secretary, sir.
Sir, before Tasu start, one more updation. He also attended various training sessions in USA for this, especially for this equity market. We both have completed recently the certificate course on financial analysis and technical analysis also. So, Tasu sir, sorry, we request Deepak Ladda, Chairman of the branch, to give welcome address. We forgot to ask him in an excitement. Sorry, sir. Please.
I understand the charm on your face and the excitement, because a very good speaker is that. It doesn't matter. Warm good evening and welcome to Hyderabad, Trasu sir, virtually.
Thank you, sir. Thank you.
And warm good afternoon, good evening to all the members who have joined by this time in large number. And I hope that when the actual session starts in a couple of minutes, the number will go up. Friends, this is a part of second day program, back-to-back on investor awareness, which is to be conducted under the investor awareness program as a part of the CP mandate. So yesterday on Saturday, we had importance of forex and hedging and risk management, which was taken by NSC officials and the fund manager from the Pune. He has taken us the forex and risk management very well. And today we have Trasu sir, who will tell us the wisdom in equity instruments. So looking forward for a second wonderful session back to back. Thank you, sir, for agreeing to address Hyderabad branch mention, although virtually. We would like to have you physical also sooner this year.
Thank you,
whenever
sir.
your time permits. So, friends, before handover, I just want to have a couple of announcements before the members. 28th and 29th, we have a national conference on forensic audit and disruptive technologies by all the national level speakers. It's a 2 days physical program conducted under the aegis of Digital Assurance and Audit Board. It is at the Hotel Park, Hyderabad. So members from Hyderabad will attend, and the members who are already virtual attending from other cities requested to please make your travel arrangements for 28th and 29th. It's going to be a wonderful program as to know about the latest technologies and the new age developments, which is having our developing around our profession. So request you to please register for the program, and also for the announcement for the members in Hyderabad. We have the MSME Yatra and MSM Setu that is reaching Hyderabad on 27th of this month. As it is coming from Vijayawada on 26th, it is reaching. We have, as we all know, ICAI MSME committee is taking a MSME bus across 75 cities, 75 weeks, 75 program as a part of Azadi Ka Amrut Mahotsav, and every city the MSME bus is getting received in a very well manner. So similar arrangements have been done at Hyderabad branch also to make sure that MSME Yatra gets a very good receiving from the Hyderabad branch. Trasu sir, I think it is arriving at 26th on Vijayawada. After from that program, it is coming to Hyderabad on 27th. From here, it will go to Bellary. So request you to please register for that MSME program. The details are already hosted on the website. So with this, thank you for the opportunity, Ravi Shankar Reddy. Back to you.
Without wasting much time, I request Trasu, today's speaker, to start his presentation. I am also eagerly waiting for this. Thank you.
Good evening, all of you. First of all, I would like to convey my thanks to Managing Committee of Hyderabad branch of SRCF ICI. This is my privilege to convey my thoughts on regarding equity share market. So thank you for giving this opportunity. Today's session is very particular interest of those who wants to trade or who wants to invest in the equity markets. Those who wants to develop interest in the equity markets by way of trading or by way of investing, for them definitely it will be helpful session. See, we all know that every profession has some set of specialized qualifications, standards of education, training, etc., by which they acquire knowledge before jumping into the real practice or a real profession. See, suppose in case of a doctor, they do MBBS, MD, and internship like house surgeon, then they do practice, right? In case of a CA, we study so much material and we write examinations. Parallelly, we do articleship, then we do job or practice. In case of engineer, musician, pilot. So in every profession having some set of skills which they're supposed to learn. Then they do real practice, a real job, whatever it is. But in case of stock trader, what kind of formal education which they should have? Unfortunately, many stock traders are not having such kind of knowledge. So here, what I am trying to say, even stock trader also, there is no exception. They should acquire a skill by way of reading some good number of books, by doing the right kind of practice. So to become a successful trader, they must acquire certain set of skills before jumping into the trading or investing. So what is happening now, due to digital era, everyone having a smartphones and they are going into Play Store, they are getting some brokerage apps, just they are doing left and right trading. So without knowing some basic fundamentals. So finally, what is happening? People are losing so much money in the stock markets because of without proper practice, without studying what exactly happening in the share market. So in this session, I am trying to give overview of the stock market, how it operates exactly. All are facts, everything is a practical approach. I don't want to push so much theory in this session. So to the extent possible, I will try to explain in an easy manner in the practical approach. See, what happened, the retailer retailers most like stockbroker name called Giroda. What their analysis is telling, less than 1% active traders beat bank FDs. See, what it means, 99% of the stock trader, they are almost losing their capital. See, balance 1% of traders, just they are managing it just like bank FD rate of interest. So what is the main reason? So traders are not interested to learn. They want easy money. Today, just they will download the app. Tomorrow morning, they start trading. So how they do depends on their, not based on skill, not based on practice, depends on their mood, depends on their luck, depends on their tips. So many reasons are there. So after completion of this 1.5 to 1 hour 45 minute session, so we should be aware what to do and what not to do. So what I have done here, the entire discussion which we are going to have in next 1.5 hour to 1 hour 45 minutes, I have divided 5 parts, my presentation. So after presenting 5 parts, then we will have a time for question and answer session for 15 minutes. The first party, I will talk about types of companies which can be tradable, which can be investable among listed ones. So what happened? More than 5,000 companies are listed in the stock exchanges. Out of 5,000 companies, how many companies are in the bracket of tradable? It can be tradable. So to get a maximized return, I will explain you. Next, I will take you through a couple of variables which will have a significant impact on share price. So how earnings behaves on share price, how price earning multiples behaves on share price. Then we will look at different stages through which a stock goes through. This is very important concept, stock stages. I will try to explain to the extent possible based on available time. Further, I will help you to understand what to buy, when to sell, how to sell. Everything will be covered here. Finally, I will make a very special emphasis on how to protect the capital, how to take profits into pocket, how to do position sizing, how to manage risk, so how to preserve the capital. So that will be covered in risk management session. As we can see here, there are 4 cards here. One is leaders, second is top competitors, third one is institutional favorites, fourth one is turnaround stories. When I am considering any stock for purchase, the first thing I do is to determine what kind of situation I am dealing with. So what kind of situation I am dealing, what it means, any stock should be fit into. It can be a leader, or it can be a top competitor, it can be institutional favorite, it can be turnaround story. If any stock which I want to buy is not fit into any of these 4 categories, I will not buy. So trader should not buy. So investor should not invest. So any stock should be categorically fit into any of these category. The first category I will explain. So then we will go one by one. The first one is the leaders. It is a market leaders. So I explain you what is a market leader means. Earnings growth, revenue growth. If you see number of companies, only some companies can able to post good earnings growth. Some companies can able to grow revenue growth. If any company having capability to grow their earnings by 30% growth, 40% growth, triple digit growth, so it will be very best company for considering into buy list. So I am not telling that you should go and buy that all leaders. I will explain you. So earnings growth is very important. We know that in case of real estate, what is most important? What is the most important? Location, right? Location. So we see the location before putting good amount of sizable amount into real estate. We see where site is located, where estate is located, right? Location is most important. In case of equity share, earnings is the very most powerful thing which we want to look for. So in here market leader means very strong earnings growth. Strong earnings growth means within the 2.5 years, within the span of 2.5 years, 2-3 years, it should be double. Earnings should double. Suppose EPS is 10 rupees in 2020, by 2022, it should become 20 rupees, then 40, then 80, 120. So what has exactly happened in Bajaj Finance also? So revenue growth also same, because without revenue growth, it is not possible to get good amount of growth in the earnings. So because of cost controls, that is a limited only to get earnings growth. But in case of revenue, if company parallelly growing by revenue, there is a high possibility of getting earnings growth also. Next, margin expansion. What margin expansion? So how much net profit they are getting, how much of sales they are doing. Suppose if some company having a margin of suppose 8% gross margin or net margin, so by year after year they try to improve their margins. Then what happens? Even 10% sales growth also, earnings may double. 10% to earnings may show 20% growth. So earnings growth, revenue growth, margin expansion, they're the best combination that we are calling as a leaders. Next, stock price performance. See here, most important thing. Suppose we find out one company, their earnings are good, earnings growth is good, revenue growth is good, margin expansion is good, but stock price is not performing. It is same level as like 6 months back, 1 year back. That is not a leader. That is not a market leader. Market leader means it should outperform the market also. Not only fundamentals. First, earnings, revenue, margins are fundamentals. The stock price also, it is a technical parameter we should look into. So we are demanding not only fundamentals, so share price also should perform, at least outperform. Then only we can call as a leader. Reason I will explain in next coming slides. Then high PE, high price earning multiples, near 52 week high, that is share price. Generally what happens? Always leaders having high price earning multiples. It is almost double the average of PE of Nifty or Nifty next 50. Always leaders having a highest PEs. Next coming slides, you will get full clarity. Near 52 weeks high. Generally, it trades near 52 weeks high. Almost 10% close to 52 week high, 15% close to 52 week high, like that. It is not like that penny stocks. It is not cheap stocks. It's very quality stocks and very costly, we can say. So many are mid-cap companies. So this is very most important. Many are mid-cap companies. What here? Mid-cap companies generally usually less than 10,000 crores market capitalization, maybe 20,000 crores capitalization, less than 20,000 crore market capitalization, like these companies. Because what happened? There is initial levels of the initial stage of the company where earnings are showing dramatically growth. Example, Amazon in 1991, Google in 2000, we can say that time they are leaders of the market. Leaders of the market that we can call as a market leaders. So first to emerge in new bull market. Whenever bull market starts, after bear markets, what happens? The leaders will first emerge. Suppose Nifty up by 30% for 6 months, the leaders may be 300% returns, 400% returns, 500% returns, like that it gives returns. So leaders are a very good category. So most of the traders will invest 70 to 80% of their money into market leaders. Rest of the 30% of their capital, they will put into top competitors, institutional favorites, and turnaround stories. That I will explain you. So next, top competitors. In case of top competitors, they are second place, third place, in terms of earnings, in terms of revenue, in terms of margin expansions, in terms of stock price performance also. They are in second place or third place. Almost if any specific industry is started to perform in terms of share price, leaders are first to perform. Then top competitors will follow the leaders. So not only in terms of fundamentals and share price also, both are in second place only in case of top competitors. Next, institutional favorites. Institutional favorites means high number of institutional holding. This is official growth stock. Example, HDFC Bank, Kotak Mahindra Bank, Asian Paints, Pidilite, Astral Poly. So number of companies like this. So institutional favorite means low to average stock performance. Suppose in case of a market leader, their earnings growth is 30% or 40%, but institutional favorites maybe 15 to 20%. What happened? Institutional favorites is nothing but a large companies and big companies. Their earnings also may not grow substantially, but they can grow till 15%, 20%. That is because of management capability. So that is because of management capability. Mostly mid to large cap stocks we can find out in institutional favorites. See, in case of leaders, sometimes we may not heard about that names. Mostly all new names in leaders. Suppose in 2020, it might be leader. In 2030, it may come to institutional favorites. Is it clear to you? So leaders means this is a starting stage of the uptrend of the share. That is the starting stage of the uptrend of the share. The fundamentals are improved. Stock is giving good performance, high relative strength. But in case of institutional favorites, by the time reaching institutional favorites, more than 500,000 institutions are holding that stock. Generally, in case of market leaders, maximum 20 institutions may hold that stock, 20, 30, 40, 50 or 100. So if you categorically fit into institutional favorites, by that time, maybe 500,000, 2,000 institutions might be holding that stock. So I will explain. Okay, remaining part. Next, turnaround stories. Turnaround stories are fundamentally having a fundamentals have started improving. So till this time, they don't have proper fundamentals. There is no proper earnings growth. There is no proper revenue growth. There is proper margin expansions. Now they are coming out from the bad situation. They are trying to join in a good category of the companies. So they may change in business. New leadership may come. So that something they are trying to come out from difficulties. That is a turnaround stories. So out of 5,000 listed companies or more than 5,000 listed companies, leaders may be 20 to 30 companies, top competitors, one more 20 plus 20, 40, institutional favorites, 200, then turnaround stories. So maximum tradable companies which are listed in the stock exchange is close to 500 out of 5,000 companies. Remaining 90% of the companies we can call as a laggards. Laggards. So what is laggard? Laggard means it does not have any merit in buying because they don't have earnings growth. In 2010 EPS is same, 2020 EPS is same. In previous 10 years, they are not improved much. They are not improved in terms of revenue. They are not improved in terms of earnings. They are not improved in terms of margin expansions. Very low PE stocks. It might be traded 52-week low. Maybe mid-cap companies or large-cap companies or a small company. Irrespective of the size of the company, these all are laggards. It no longer has any growth story. No growth story. Just they are doing business, not getting any improvement in earnings. So it is not considerable to buy anymore. That is laggards. So we are interested to find out company. It can be a leader or it can be a top competitor. It can be a institutional favorites. It can be turnaround stories. Actually, one IBD is there. IBD in the US, that is a business magazine and business analyst. What they have done, they have categorized total industries into 197 industries. Out of 197 industries, all industries may not perform every year. Some industries may perform well, some industries may not perform well. I am talking about share price of that particular industry. So we have to consider top 10 industries only in the market leaders because they perform very well. So rest of other industries, it is not better to have in our portfolio. So how long leader can last? It may be 18 months, or it may be 1 year, or it may be 2 years. So leader will not, we don't think that leader will be for forever. It may be for 10 years, 20 years. Don't think like that. Leaders may be for 2 years or 3 years. So when stock is not performing, then we should not consider it as a leader. Is it clear? Is it clear to you? Everyone is with me,
Yes,
right?
sir. Yes, sir. Yes, sir.
Okay. Fine. Right. So what fundamentals we need to focus on? So some cards which I am displaying here, these all are very important fundamentals. These are the most important ones one should look for. So as audience, all are my professional colleagues. I am not explaining basic meaning of these terms. However, I would like to bring to your notice that how we need to respond to these factors. The first one is earnings growth, which was already explained. Earnings growth is very demanding factor. This is we want. Suppose some share is performing very well. If there is no earnings growth, we are not interested. This is very short term only. So long term it won't survive. In case of a sales growth, also same thing. So without sales growth, earnings growth is very difficult. So because they can control some cost, by that they can grow some earnings. But how long it can be? Very short span of time. If they grow by sales, what happens? Earnings will consistently grow. At least we want to look for earnings should double by minimum 2.5 to 3 years. If earnings are not getting double within the 3 years, we are not interested. Fundamentals are not so good. So then margin improvements. So practically margin improvement not possible for every year. To the extent possible, they have to try for margin improvement. Margin improvement can be possible by way of cost leadership. So because what happened in some companies, if you look like Balakrishna Industries, Aparo Tires, and Page Industries, in case of Jockey, they have improved margins very well. So many competitors came into the play, but they can't able to survive because of cost leadership of these companies. So margin improvements every year not possible, but at least they have to maintain good margins. Next, scope of expansions we have to see. See, if you see so many companies expand by way of bringing funds from borrowings, that is debt funds. So we have to look for optimum mix, whether they are expanding by internal accruals, that means reserves, or by debts. At least it should properly balanced between internal accruals and debt. If some companies by expanding by way of debt, it is very difficult to manage the situation. Suppose if business is not doing well in any quarters or any years, that time how they can pay interest costs, how they will repay the principal, that is very not good sign. So at least we have to look for a proper leverage in terms of debt and internal accruals for the scope, and at the same time we have to see scope of expansion. Example, if you see DMart, every year they're expanding so many stores, right? So scope of expansion, so we can say that how much scope they have. Suppose if they are having a turnover of 1,000 crores, they may having scope to increase 1 lakh crores, right? That is the scope of expansion. Next, disruptive. See, actually what is happening, sometimes new technology becoming a old technology. So recently also product-based technology companies are performing much more better than historical software companies. So disruptive means this factor which we need to study very carefully. So then other factors like return on equity, corporate governance, etc. So corporate governance and all, as an investor, we can't able to judge properly. But return on equity, you can see 15% return on equity or 20% return on equity is good. Return on equity should not be in a negative. Whenever they are getting good profits, right, definitely they will have a good return on equity. So that's what I want to tell here. So I am very most giving importance to earnings growth and sales growth. If these two factors we are able to identify, remaining automatically will follow, right? So what is share price? Arithmetically, we can tell earnings per share into PE multiples. See, in Bajaj Finance, in 2015, earnings per share is 18 rupees. In 2022, earnings is 116 rupees. In 7 years' time, earnings has almost increased by 540%. In CA compounded annual growth rate terms, it is increased by 31%. So what happened to share price? In 2015, share price 400 rupees, 22, it is almost 7,000 rupees. In 7 years, it has dramatically improved by 16 times. That is 1600 percentage. If you see on CAGR basis, it is 51 percentage. How is it possible? Say in share price, earnings is one variable factor, P is other variable factor. In this case, earnings are increased by 548 percentage. How can share price increase by 1600 percentage? Here see PE. When in 2015, PE multiples are just 23. 22 what you see, just number is 63. Some people may thought that 23 is very costly. Then what we can say here is for 63. See, PA multiple is here given a 3x returns again. That means instead of 500% returns, it is given a sorry, it is given a 1600% because 1600% returns because of PE re-rating. So PE re-rating is very important, but that we can't control, but it will be decided by the market. Earnings per share is determined by the company. PE is determined by the markets. Is it clear? Is it clear to you? Here, what I am looking, earnings growth I am looking. So, what conclusion can we draw from this? What conclusion we can draw from this? Earnings are improved by 540%. Share price automatically follows. So, next company, Pidilite. In case of Pidilite, what happened? Earnings is 10 rupees. In 2015, in 2022, earnings are 24 rupees. What happened to share price? It is 600 rupees in 2015. In 2022, it is on 2,485. The 7-year absolute performance, earnings gone up by 140%. Share price has gone up by 300%. In CAGR terms, earnings per share 13%. In CAGR, earnings per share is 13% growth. In share price, 23%. Here, what happened? See, in 2015 itself, PE multiples of Pidilite is 60. In 2022, see what happened? It is almost close to 100. Then PE multiples also here playing two variables. Earnings are gone up, PE multiples are gone up. Then share price automatically exploded like anything. So that is in the case of Pidilite. So whichever way you look at, without earnings improvement, it is certainly not possible to see stock price performance. So based on the figures which we have, I am quite certain that PE come into positive play only there are earnings acceleration. If there are no earnings acceleration, it's very difficult to find out, very difficult to get good PE numbers, good PE multiples. Is it clear to you? Is it clear? I don't know you are following or not. Okay. Right. Next company which I took is Alkyl Amines Limited. So Alkyl Amines 2015 earning per share is 9 rupees. In 22 earnings are 44. It was increased by almost close to 400%. You see share price. Here you see share price. In 2015, what is the share price? 130. In 2022, 3,151. It is given a wonderful performance of 2,300%. On CAGR basis, 58%. Almost every month it is giving 4 to 5% of returns till here. So in earnings, it is 25% growth. So PE, what happened? In 2015, it is just 15. In 22, 72. So PE multiples has re-rated by 5 times. So earnings has gone up. PE multiples are gone up. See, by 390% of earnings, company has able to manage 2,300% returns because of markets is given a good re-rating. That's the demand of the share. Yeah, this is very important. Share price equal to earning per share into PE multiples, which we have already discussed. In case of NTPC, just you see these numbers. Just you see these numbers. What kind of conclusion you can draw? Can you draw from this? Just see these numbers. See, please understand one thing here. Company can be a great company. Company can be a great company, but stock need not be. Stock need not be. See, earnings are 10 rupees in 2015. In 22, 17 rupees, just 8% CAGR. So what happened to share price? 123 in 2015, 22, 142, just 2% growth. Don't see a 7 years absolute performance. See on CAGR basis, it is just 2% excluding dividends. So PE in 2015, 12. Somebody may thought that 12 is very cheap, we can buy. In 22, what happened is very cheap. It is very cheap. Suppose in 2032, it may going to become very, very cheap. So we should not buy any cheap stocks. We should not buy any cheap stocks. So we have to look at least minimum earnings growth. Minimum earnings growth. Here, no earnings growth. Very little growth is there. That is just 8%. Minimum, we have to look for 15 to 20% growth. At least in last 3 years. At least last in 12 quarters. We have to look for minimum 15 to 20% growth. So is it clear? Is it clear? Then next company, Sun Pharma. See, check earnings. In 2015, earnings are 22 rupees. In 2022, 14 rupees. Degrowth, minus 6% degrowth. Share price, degrowth, minus 2%. PE multiples, just able to manage same number. So don't trust the numbers. Don't trust the stories. Just listen to earnings. Just see the stock price performance. If stock is not performing, why you are buying that stock? Why one should buy that stock? If someone is telling that is a great company, they are getting good orders in the future, they are getting good statistical developments, synergy, so many things the people tell in media or newspapers and like in social media. So wherever, so they may try to give good kind of picture for bad company. So don't listen all of those things unless share price is performing. If company is good, why stock is not going up? If company is very well, why it is not going up? You ask them. So this is Sun Pharma story for last 7 years. There are no returns. Simply, I can say that there is no earnings growth. That's all. Next, Hero MotoCorp. I don't want to explain everything here. Just simple. In 2015, earnings are 118. 2022, earnings are 115. Degrowth of earnings. Again, see share price. What happened to share price? Minus returns. PE almost same number. So no earnings growth, because of which price has not moved up anywhere. So those who understand this concept well, they have all been able to identify the share price behavior. Those who understand this concept well, very easy. So nothing has really performed well, whether it is ONGC, Coal India, all of them having same characteristics. If you see public sector companies, most of the public sector companies not able to grow their earnings in the last 10 years by 15%. In last 10 years, they are not able to give proper returns to the shareholders because of they are not expanding properly. They don't have proper management. So that's such kind of businesses they are into. So we should not get into such kind of companies. So this is very, very most important slide, which I'm going to explain here. Is everyone is following me? Can we go ahead? Can we go ahead? Hello.
Yes, please go ahead, sir.
Okay, fine. Thank you. Yeah. See, a stock goes through 4 key stages. Stage 1, stage 2, stage 3, and stage 4. See what happened. This is a very important point. So this part is a stage 1. This part is a stage 1. This is the second stage, stage 2. This is a stage 3. So this is again stage 4. This is stage 4 is very clearly downtrend. In stage 1, what happened? No institutions like pension funds, mutual funds, banks, insurance company, That means DI, we can call as DII, FIS are not interested at this level, because they may not like the fundamentals of the company. If you see stage two, so many institutions like DIIs and FIS are trying to buy that stock, trying to accumulate that stock. So that is the reason stage two, it is going up. In case of stage three, what has happened? Institutions are slowly exiting the stock. If someone has entered here, some institutions, they are exiting at this level. So very smart institutions exit in stage three. In stage four, fundamentals of the company is getting downgraded. Earnings are no earnings improvements, no revenue improvements, no margin improvements, and then it get into stage four. So we have to look for companies where they are started uptrend from stage one to stage two. That those type of companies are we can able to identify, we can able to research further before buying, before going to any stock. For a trader, for an investor, for everybody, we should not invest into the stage one. So why? Because in stage one, it is a loss of time, neglect phase, consolidation. Nothing is happening. It may be for I will show you some examples. Okay, I given some good number of examples. Okay, in stage one, what happened? It is just loss of time only, neglect phase. So nobody is interested to buy that stock, just consolidation. What reason might be? Because of earnings might not be increased well, might not be improvement, sales might not be showing any growth. That is the reason stock might be in stage two, stage one. But in case of stage two, what happened? Many institutions are wants that stock. They are buying, they are accumulating that stock and positive returns. It is like, suppose some companies for almost 10 years or 5 years might be spent time in stage one. The moment stage two starts, within 2 years time or within 3 years time, it gives returns like 300%, 400%, 500%, because demand for that stock is like that. So we should identify what kind of companies are started beginning uptrend from stage one to stage two. We should not enter into stage three. In stage three, what happened? Many institutions might exit in the stock. That is a distribution. What is distribution? They are selling, retailers are buying. They are selling, retailers are buying. Who will buy from retailers? No one will buy from retailer. That is a stage four, loss of value, declining phase. Is it clear? There is a stage analysis of the stock. So in stage two, tremendous volumes will increase. Why volumes will increase? Institutions will not buy 1,000 shares, 2,000 shares. They buy like millions of shares. So we can able to see very clearly in the stock chart that huge volumes are building up in stage two. That is very clear confirmation. Institutions are step into the stock. They are buying that stock. So most of the stocks are unfamiliar names in stage two. By the time reaching stage three, everybody knows that stock. We can able to see in media, we can able to see like newspapers or like Twitters, in social media, we can able to see at stage three level, because that time that company is popular. But in the case of stage two, it may like 18 months or 24 months, it may spend 36 months. In that time, the company name is unfamiliar. Most of the companies are new names only. Is it clear? So a spike in price and significant volume after indicates institutional buying, which is exactly what we are looking for. Not to buy falling stocks, whether it is in stage three or stage four. We should not buy any stagnant stocks, which is in stage one. The moment institutions are accumulating the stock, that's when we are interested. We will give sufficient time to understand how a stock behaves in stage two. Is it clear? We are interested in stage two only, not in stage one, not in stage three, not in stage four. So as a retailer, we are trying to find out how institutions are behaving to that particular stock. That is where our money should be. Because today we buy some shares, so after a month or after 2 months or after 3 months, some institution should come and buy from our hands. So if no institution is coming, what happened? Nobody will buy. So retailers, you see, in Indian stock market, 90% of the volume is created by the institutions. Only 10% of the volume is created by the retailers. So we should not depend on retailers. When we are holding any stock, we should expect some institution will come and will buy from our hands. The next slide. See, this company chart is Zoom Video Communications. Zoom. Today we are conducting meeting in the Zoom, right? Same company, the stock. Just to see, analyze. So just I am showing here. This is a stage 1 of the company. This is stage 1 of the company. At this level, it is 100 rupees. From 100 rupees to 500 rupees within the span of 1.5 years, it has been reached by huge volumes. You can see here, huge volumes has been built up. Huge volume has been built up. Then what happened? Once it reaches to here, from 500 or 570 rupees, slowly stage 3, very little time spent on stage 3 here. Finally, it is coming down all the way to just it is dollars actually, not rupees. Zoom is listed in US markets. Just I want to say I want to take practical example. That is the reason I took Zoom. Okay, here it is just reaching less than very small number. It is some $72 or whatever it is. So almost 90% of the value has been lost here. We can see here the all 4 stages has completed in 4 years. So again, it may stop. So this is the one cycle. Again, the cycle may repeat. We are not sure. Some companies may spend decades after decades in stage 4 only. They will not try to reach stage 2 again. Some companies, what happened? Again, they will try to reach stage 2. That's what we have discussed in initially is called turnaround stories. Here in stage 2, huge accumulation is happening. That is the reason volume has been built up very well. Is it clear? So we should buy at this level. Then we have to live at this level, at least at this level, at this level. We should not travel to this level. Next slide. Next one is Upstart Holdings. This is also a very popular company. Many of you people may aware who trades in US stock markets. So this is also same story. See, this is stage 1. Then immediately stage 2 has begun from $22. It has been reached to 380. Again, almost 98% of the value gone. See how it is behaving. So if you are not leaving stock at least at this level, then you should at least you have to live here. By that time, almost gone over. Stock can go directly from stage 2 to stage 4. Here, stock is not spent enough time at stage 3. When no volume in when no volume in stage 2, what happened? It will fall very quickly. And see, if you see here, volumes has been not built up so much, but price has been gone up. Finally, it has come down. So this is IndusInd Bank. This is weekly chart. IndusInd Bank, what happened? After this is, we can say stage 2 uptrend. After stage 2 uptrend, again it started coming down. So almost from 2,000 rupees, it has reached to 500 rupees. Again, it is trying to go for stage 2, but still it is in stage 4 only. At least this you can call this is the stage 1. This is the stage 4. This is the stage 1. This cycle may get repeat. We are interested on uptrend stocks only. Stage 2 uptrend stocks only. We are not interested on downward stocks. So Stock can go directly from stage 2 to stage 4 sometimes. Sometimes it may spend time in stage 3 also. So this is Yes Bank. See what happened in stage 2. It was performed very well. Then stage 3, it was not taken any time. Directly it come down from stage 2 to stage 4. To move upwards, it may take months and years. But to fall from higher level to lower levels, it may take just weeks only. For suppose it has from here to here, it is reaching from 2006 to 2018, it is reached here. Just in the span of 1 year, it has almost come down to almost nil. How low stock can go? Any stock can go to zero. Any stock can go to zero. So don't think that stock is safe. Don't think that stock is safe. We should buy at this level, stage 2. Moment we are getting doubt that it is in stage 3, we should leave that stock. We should leave that stock. Otherwise, what happens? We will lose entire money. Entire money. No stock is safe. No stock is safe. Company can be a great company, but stock need not be a great stock. This is India Bulls Housing Finance. See clearly. Stage 2 accumulation, stage 3, then stage 4. If someone bought here, what happened? See, if share price is coming for cheap, then definitely it will be very costly, because people will lose money in this kind of downward stock. If someone bought at 1,200 rupees, if stock come down to 600 rupees, what is the loss? How much loss? 50%. If someone bought stock at 600 rupees, it is fall down to 300 rupees. How much loss? 50%. If someone bought at 300 rupees, stock reached to 150, again 50% loss. If someone bought at 50 rupees, his stock reaches to 25 rupees, what is the loss? 50%. So don't think that stock is coming for cheap. Some agents are there. That is the reason. That is the reason stock is coming for cheap. We should not buy such kind of stock. Institutions are selling that stocks here. Here, if you see here, huge volumes are there. Institutions selling this kind of stocks. Who is buying? Innocent retailers are buying this kind of stocks. This is Tech Mahindra. In Tech Mahindra, this is a very clear uptrend. It is a weekly basis chart. Weekly basis chart. There are two lines you can see here. One is a blue color line. Second is a red color line. It is a 10 exponential moving average line. This is 20 exponential moving average line. At least current stock price should be above 10 or above 20. At least it should be above 20 exponential moving average. I am not interested to hold any stock which is breaking down 20 exponential moving average on weekly basis, on weekly chart. So suppose if you, this is very important rule, what I believe. So after studying tens of thousands of stock, what I have learned, any stock which is breaking down from 20 exponential moving average on a weekly basis, we should leave that stock. We should not hold that stock. If you follow this rule, even S Bank also, someone might not lose big money. We should not hold any stock which is trading below 10 EMA, 20 EMA. We should hold the stock only when stock is trading above 10 EMA, above 20 EMA. Is it clear to you? So I am taking one more stock, TCS, Tata Consultancy Services. So please keep in mind, company can be a great company, stock need not be. So here, if you see, here I am highlighting here, from here to here, most of the time stock has spent above 10 EMA, at least above 20 EMA. Here what has happened? Stock is trading below 10 EMA, below 20 EMA. EMA means exponential moving average. They give more weight to the recent year numbers. Here what happened is trading below. So I am not telling that this is stage 3 or stage 4. I am getting doubt that this is stock may be going to stage 3. Because the trading generally in stage 2, so number of stocks which trades about 20 EMA, not below 20 EMA. If stock is trading below 20 EMA, one should exit that stock. Again, The moment again crosses above the 20 MA, then we may think for buying again. We should not wait for uptrend again. Just you leave the stock, again the stock is taking uptrend, then we can see for buying. So this is the TCS. At this level, I am not interested. The simply one reason, the stock is trading below 20 EMA, below 10 EMA. I am interested only like this kind of situation. Stock should trade above 10 EMA, above 20 EMA. Even for a trader, even for investor, this rule applicable. For investor, trader also, both are money only, right? The way of approach is different. Don't think that suppose if someone is thinking I am a long-term investor, I hold stock 10 years, 15 years. So that is up to them. But I don't like that kind of approach. I'm interested only in stage 2 uptrend stocks that is traded above 20 EMA, that is traded at least 10 EMA. Every time what happens practically, sometimes so it may break down 10 EMA, but it will not break 20 EMA. See Tata Elxsi, see how beautifully, this is stage 1, around some 1,000 rupees. From 1,000 rupees to stock has almost reached to 8,000 to 9,000 rupees. See, it has never break down 20 MA, only this case, only here. What I do, I will exit here. Again, I will enter here if required. I don't want to hold the stock which is trading below 20 EMA. This is very clear stage 2 stocks. So by this time, most of the people may aware of the stock. Most of the people may aware of the stock. So we should catch the stock at this level, at least at this level. Very easily you can identify what stocks which are trading in stage 2. Generally in stage 2 stocks, most of the stocks will not give correction more than 25 to 30%. Sometimes what happens, indexes in Nifty are like indexes are correcting 10%, 20%. Maybe the stage 2, sorry. Maybe the stage 2 stocks may correct more or less with indexes. Is it clear? Again, I took Gujarat Fluorochem. See how beautifully this is the stage 1. It started breaking from stage 1, with huge volumes. See how volumes are getting up at stage 2. So always it is trading above 20 MA till here. Again, it has breakdown. So at this level, I am not interested to hold the stock. I will leave the stock at this level because it is coming down from 20 MA. That is red line is 20 MA. Blue is 10 MA. See here again, it is going from 10 MA. It is crossing 10 MA. Here I am interested. Here I am interested. I may hold till here. The moment it is breaking 20 or 10, I will leave. So it is very safe method. At least we can preserve the capital. Someone may not get good profit. At least they can preserve the capital. So where we can buy in stage 2, that I will explain. In stage 2, we should not buy every point at stage 2. That I will explain. In stage 2, in what kind of points, where we have to enter into the stock. But in all, see, in stage 2, it will start from almost 1,000 rupees. It is reached to till 4,000 rupees. Okay. In stage 2, where we have to enter into stock, where we have to exit, I will explain buy rules and sell rules. I don't want to explain much here. Just I want to show stock is in stage 2. See, this is the pros industry. See, one can very clearly see how volumes are increased. Why it is going uptrend in stage 2? What is the reason? Many DIS, many FIs are selling, FIs are buying that stock, accumulating that stock. Then who is selling? Maybe some retailers are selling their stock. Maybe some other institutions are selling this, small institutions are selling their stock. But most of the institutions are increasing their holdings. So this is what we have to look for. So we can easily identify quarter on quarter basis for every company, how many institutions are increasing, How many number of institutions are increasing the stock, holding the stock? On what value they are holding the stock, and what percentage they are holding the stock. So as we know that in company financials, so they disclose. So based on that, we can able to identify. But practically, it's difficult to revise all financials. Ready-made information available. That also I will show you. I use one website called MarketSmith India. In MarketSmith India, I can able to identify very easily that quarter on quarter how many institutions are increasing. How many I am interested on only institutions are increasing, then only I am interested in that stock. If institutions are decreasing, holding that stock, if institutions are selling that stock, I am not interested. So here you can see institutions are building the positions with huge volumes, almost from 75 rupees or 100 rupees, it has reached to 400 rupees. So again, what happened here? It saw some break. But volumes are not coming. So no supply, no huge selling. They are waiting for some fundamentals to improve. So before accumulating further, they are waiting for some fundamentals to confirm. So this is the stage. This is not stage 3. This is not stage 3. But we are not much interested at this level because volumes are not improved much. If it crosses maybe 450 or 500 rupees, then we see how again how many institutions are coming to buy that stock. That I will show you some different in other website how to verify institutional holdings. What is company name? Wipro. So beautifully increased from here to here with good volumes. Again, it is coming down. See what I told earlier. Any stock which we are holding, it should trade above 10 EMA, 20 EMA. So here, when it was failed, that condition. When it was failed, it was failed at this level. At least we should leave the stock at the 640 rupees before going stock at 370. Is it clear to you? So whatever portfolio you are having, whether it is long term or short term, we should not hold any stock which is breaking down from 10 EMA or 20 EMA. This is a Wipro company, a great company. At this point of time, can we buy the stock? Answer is no. Why? Because the stock is trading below 10 EMA, 20 EMA. How can buy the stock? Our stock should trade above 10 EMA, above 20 EMA. At least you see here where I'm placing cursor here. I am highlighting this one. At this point, at least it is trading about 10 EMA, 20 EMA. If you buy this year, till here, it was not break down at 20 EMA. Is it clear? At least we should place proper system in place, whether our whatever stocks is in our portfolio is trading about 20 EMA on a weekly basis. Here, weekly basis means each candle indicates 1 week. That is a price behavior. That is price behavior of the stock. So this is Dish TV. This is very clear. Now it is trading around 20 rupees. If someone bought at this level, hoping it will reach 52-week high, again, it is very risky proposition. It may go to 10 rupees. It may go again 50% of the capital may lost. So this kind of cheap stock we should not buy. If someone buying at 16 rupees, it may go to 8 rupees. What happened? Loss again. See, mathematics will work in reverse in stock market. If stock price rupees 16 to 80 rupees, what is the loss? 50%. Again, to reach break even, how much price it needs to be increased? 100%. Very simple. Otherwise, if you see very simple, for 100 rupees stock is decreasing to 50 rupees, what is the percentage of loss which one have? 50%. To reach break even price, to reach cost price, what percentage it needs to be increased from 50 rupees? How much percentage? 100%, not 50%, right? If stock is coming down by 25%, to reach break even, it has to improve by 33%. Is it clear? If stock is decreased by 20%, to reach break even, to reach cost, it has to increase by 25%. So this is very risky. See here, almost most of the time is trading below 20 EMA, 10 EMA. I don't want to talk more. I'm telling very clearly that we should not hold any stock which is trading below 20 EMA or below 10 EMA. It's very clear. See, almost it has lost at this level only. It has broken down at this level only. Why we have to hold these kind of stocks? Is it clear? So next one, how to identify stage 2 stocks, uptrend stocks. My starting point always to have buy the stocks which are in long-term uptrend, that is in stage 2 stocks. So we saw here, right? We want to buy the stocks which are holding here this time. It is better to buy at least at this level. Then you can hold till some period, then we can sell it. We are not interested to buy stage 1, stage 3, stage 4. These 3 propositions are very risky. We should not hold such kind of stocks. So how to identify stage 2 stocks? First one is institutional footprints. As I told, here many institutions are trying to accumulate the stock because of they like fundamentals. They are expecting good earnings growth. They are expecting good revenue growth. So with huge volumes, they are accumulating the stock. That is institutional footprints. We can easily identify. I will show you how to identify institutional footprints. Then stock is trading above 200 moving daily moving average. Stock is trading above 150 daily 150. Stock is trading above 50 moving averages. These moving averages are made. This is very clear that stock is trading uptrend. This we have to check. If any stock is trading below 20 daily moving average, we should not buy such kind of stocks. At least we are identifying here what kind of stocks which are available in stage 2. All stocks we won't buy in stage. We won't buy even it is in stage 2. That I will tell you in stage 2 again how to filter, how to buy, when to buy. Right. So this is stock is trading above 200, 150, 50 DMA. Next, it is near almost 52-week high. Generally, stage 2 uptrends always close to 52-week high. Somebody is thinking that it is a very costly share. It is already reached so much. No problem. Stock has doubled in last 4 months. That same stock has capacity to double again. The same stock has potentiality to give good kind of returns. So near 52 means at least to some maximum 25%, maximum 25%. It should be current stock price should be traded within the bracket of 25% from 52-week high. It should not away more than 25%. So next, relative strength not less than 70%. 70. What is relative strength? I will show you in MarketSmith India website. Relative strength is just percentage. Relative RSI is different from relative strength. I am interested in relative strength because what does it means? The stock is performing 70% better than 70% of stocks which are listed in the stock exchanges. So relative strength not less than 70 means the stock is performing 70% much more better than all listed peers, all listed stocks. That is 70. That means good relative strength. Stock is going good. Rank, 70 is rank, and we can say percentage. 70% of the stock has performed. Stock has performed well compared to peers. That we have to look for minimum rank is 70. So it is better than 70% of the stock. We can say simply it is better than 70% of the stocks which are listed in terms of share price performance. I am not talking about fundamentals, earnings and revenue and all. I am talking about share price performance. Then quarterly revenue, earnings acceleration, interested in recent 3 quarters. So we have to look for earnings growth, which is already discussed. So this is also a must. Lower volume and pullback weeks. Stock should not come down 20 EMA. Suppose Stage 2 stocks, how it behaves, every day it will not go up. Every day it will not go up. Okay. So it may go up for 10 days. Again, it will take some break. Suppose in 10 days, it may give returns of 20% or 15%. Again, 4% correction will come. Again, it will go up. Again, it will take some correction. Whenever correction comes, whenever pullbacks comes, volume should be low. What it does mean, institutions are not exiting the stock. Only some part of institutions or some part of retailers are selling that stock. They are just doing profit booking, right? So lower volumes are very most important in stake. When stock is going up, we want higher volumes. When stock is going up, we want higher volumes. So by which we can able to identify stock is buying by the institutions. When our volumes are lower volumes and pullback means stock is minimum selling, no huge selling. That means they are holding that stock. Suppose today we bought one stock, tomorrow some institution came and sold that stock. What happened? Definitely supply will come huge. Then it will go down. That's the reason. So we are interested on stocks which has lower volumes and pullback weeks. Next, more of up weeks and increased volume than down weeks. Suppose in last 10 weeks, minimum 6 to 7 weeks should stock go up, and remaining 3-4 weeks may get corrected. Supportive action and pullback, already we have discussed. Quick recoveries. This is what we call as a tennis ball action. Tennis ball. Okay, when our stock is giving a correction of 10% or 15%, some institution come and buy that stock. Then again it will go up. It will go up. So number of institution holding, increasing quarter on quarter. We are interested on number of institution holding the stock. It should go up. Number should go up. So these all are stage 2 conditions. Based on the studies of the biggest winning stocks going all the way back to late 1900s, more than 90% of the stock made their huge price gains while in stage 2 uptrend only, not in stage 1, not in stage 3, not in stage 4. We should look for stage 2 stocks only. So biggest winning stocks. Traded above key moving averages. Next, earnings acceleration. Corrections are good. It is not a bad sign. Traded above 99% of successful stocks trades above 200 days moving average. 96% of successful stocks which trades above 50 days moving average. Earnings acceleration. So initially I told that in case of real estate, what is most important? Location. In case of share price, what is most important? Earnings acceleration. 96% showed earnings acceleration. Without earnings acceleration, if stock is going up also, it will not last for so much time. It may last for maybe months only. So earnings acceleration is very important in long term. Okay, corrections are good. So 96% begin of corrections. Generally, what happens before taking off any share, it gives correction. That means some weak hands are selling, some retailers are selling. Before taking off any stock, it starts with correction. I will explain, okay, in later parts of the discussion. See, nothing new under the sun. These all are well-established studies which are developed by successful USA traders like Jesse Livermore, Williams O'Neill, Stan Weinstein, David Ryan, Mark Minervini, like Oliver Kull, and like Darvas. So popularly called as a Darvas theory, Darvas box. Many of people may not aware Darvas box theory, but how it is popular then. Most of the traders they are aware. Most of the successful traders are aware about that stock, aware about the Darvas theory. Okay, so this is a not non-negotiable criteria which is compiled by developed by Mark Minervini. So I am showing here the first condition, stock price. It is a non-negotiable. Not is non-negotiable. We should not compromise to buy the stock, even if any of the condition is failing. We want to satisfy all these conditions before buying any stock which is in uptrend. Till this time, we just buy through eyes. We saw that which is stage 2, which is stage 1 and all. Now we are telling, we are saying on the basis of some numbers. Okay, so on the basis of these numbers, we have to decide whether stock is in stage 2 or not. If any stock which is which satisfied all these conditions, definitely the stock is in stage 2 uptrend. Don't think that we should go on buy that stock. We will see. Okay, in stage 2, how to buy. The first condition is the stock price should trade above 150 daily moving average, 200 daily moving average, and next condition trending up for at least 1 month. So 200 days moving average line is trending up for at least 1 month. That means at least minimum 1 month, previous 1 month, stock should be traded about 200 days moving average, preferably 4 to 5 months minimum. Preferably 4 to 5 months minimum. Any stock which we want to consider into our buy list, the stock should be traded about 200 days moving average in previous 4 to 5 months. So why I told here 1 month? His intention is that from stage 1, some companies will begin uptrend from stage 1 to stage 2 at early stages. We may find out at early stages. From early stages of stage 2. That is the reason we are checking 1 month. Okay. But preferably 4 to 5 months is better. Next, 50-day daily moving average is above 150-day, 200 daily moving average. It is very simple that recent period moving averages should be above the 150 days moving average or 200 days moving average. That means current price is trading about 50 days moving average. It indicates short-term trend. At least short-term, it is showing very well strength. Stock price at least 25% above 50. Actually, this is don't think that it is cheap stock. Best selection will be 100%, 300%, or even greater from 52-week low. We should not buy any stock which is close to 52-week low. It is always better to buy stock which is close to 52 weeks high. So its best selection will be 100%, 300%, or even greater from 52-week low. That means it is close to 52 weeks high. So next RS. RS means relative strength rank. That preferably in this 90s. Actually, RS minimum should be 70. Higher is the better. Which I have explained earlier. Relative strength means 70 means the stock is performing much more better than 70% of the stocks which are listed in the stock exchanges. This is not RSI. This is not relative strength index. This is very technical, very simple indicator, relative strength. Just is comparing the particular stock with overall market listed stocks. Relative strength rank preferably in the 90. If 90 is better, if some stock is performing much more better than 90% of the listed stocks, that is good stock. Definitely it might be in stage 2, right? So higher is the better. If 95, 99 is super. RS line should be in strong uptrend. I will show you RS line. Relative strength should not be in strong downtrend. Line should be in uptrend for at least 6 weeks. This RS line I will explain you in the MarketSmith India website. Okay. Just I'm checking time. Okay, right. Any stock that fails to meet this criteria will not come into buy category. Will not come into buy list. Next, buy rules. See here, what is meaning of buy rule? Suppose if you apply previous filters, previous conditions which I showed you, maybe 300 to 350 stocks will come out of 5,000 companies in stage 2. If market is very wealthy, very healthy, then it may come 500 stocks or maximum 550 or 600 stocks, not more than that. We should not buy all the stocks which are trending upward. I mean, which is available in stage 2. Only some stocks which we want to buy at stage 2 uptrend. So these are the buying rules. See, first one here, non-negotiable criteria must. So any stock which is not meeting non-negotiable criteria, we should not buy that stock because that stock might be in downtrend. It may stage 3 or stage 4, maybe stage 1. If stock is meeting non-negotiable criteria, definitely that stock might be in stage 2. Okay. So non-negotiable criteria is a must. Next, tight contraction in price. Tight contraction in price means in stage 2 uptrend, sometimes how stock behaves, no selling, no supply is coming to the market. Nobody is interested to sell that stock. Everybody wants to hold that stock. Every institution wants that stock. What happens? Finally, who will sell that stock? Very few people only selling. Very few people only selling. So tight contraction. That means at some point of time, in some point of time, volumes are, we can observe volumes very low. Volumes is very low in stage 2. It begins with a huge volume. Okay, after giving 100%, 200% return, it will take some break. No supply coming to the market. Only buyers are there. Only few sellers are there. Then what happens? Very contraction in volume. Huge, only little supply will come. So then institutions won't buy. Just they see and they wait and see. They wait and see for some time. Then what happens? Price also will not move anywhere. It is just little consolidation. Little consolidation at stage 2. That is where we are interested. That is where we want to buy. So next, tight contraction in volume. Third one, tight contraction in volume. In stage 2, wherever volume is contracting, that means supply is not coming. Initially, very quietly sitting, price also not moving anywhere. There is no profit booking. That means everybody is holding their stock. No one is selling their stock. Low supply to the market. No big sell off in previous 2 weeks. Current price should not below 20 EMA. That means a small correction is there. Small correction is there in the stock. Only some people are they are taking profits. Suppose initially at the stage 2, some institution may bought the stock. Okay, after giving some reasonable returns, they might selling the stock with very little volume. Is it clear? I will explain you. Okay, next slide. Actually, this page I took from Mark Minervini book. I copied from there. I am using only for this limited purpose to explain. This one is much more better. Okay. So indication that supply has stopped coming to market. See, I am requesting everyone to pay attention here. This is very most important thing which every trader or every investor should know. Suppose, assume this is the 100 rupees. Assume the stock price is 100 rupees. So TB means trapped buyers. Someone bought it 100 rupees. Finally, it came down to all the way to 50 rupees. 50. Somebody bought here, some bottom fishers. Then slowly it is reaching to 100 rupees. Again, why it is coming down? See what happened. Whoever bought 100 rupees, they are sitting with losses because share price is coming from 100 rupees to 50 rupees. Here is the moment prices reach to 100 rupees, they will sell that stock because to get the break even, they will sell the stock. Somebody has bought here at 50 rupees. They also what to do? They get some profit. They also will sell the stock. Again, what happened? Supply is coming to market. Again, slowly it came down to not 50 rupees, maybe 75 rupees. Again, someone bought here. He is sitting with losses. Once the moment losses come, what he will think? He will not sell. Usually. He will wait to reach break-even point. It is reaching here again. Again, 2 people come and sell here. Who all are? One is a profit takers and again bottom fishers. BE means break-even. So here trapped buyers, they come and sell here again. Just they will sit and they will hope and they will pray to God that again the price should go up, price should go up like that. That's what they do. Again, once it reaches, they will sell. Just they pay brokerages only, nothing else. Again, somebody bought here, just it reaches to 100 to 80. Again, what happened? Slowly, it is increasing. Here, is selling. Again, some people who is bought here, they are selling here. See, this pattern we can look at stage 2. Okay, while giving good returns in stage 2, what happens? This kind of patterns normally appears. Where we have to buy here? Here is a very risky proposition. Here is a very risky. So we want contraction in the volume. We want contraction in the price. So that is where we are interested. So here I am highlighting here. We can buy here. Because almost supply is over. See, here some water is, here some supply is coming. Here still some supply is there. Here almost supply is nil. So in stage 2, we are interested. This kind of patterns is called a volatility contraction pattern. Volatility should be decreased. Okay, that means contraction, tight contract. We want to look for tight contraction in stage 2. In any stock which is going through stage 2, there we want to look for this kind of characteristic of the stock. We should not buy all stocks which are going through stage 2. We want to buy stocks which are going through stage 2 with this kind of character. This kind of points we have to buy, not all the time. That means all weekends are gone. No sellers are there. No volume is coming to the market. Even little demand also can push the stock. Is it clear? So this is what we are. This is this type of characteristic we are expecting while entering into the stage 2. Suppose if we are not able to see contractions at stage 2, it is very risky. Suppose after you buy, what happens? Somebody come and sell. Then if supply comes more, then what happens? Definitely share price will come down. So we have to see that there are no sellers. So this is what indicates low supply is coming to the market. So this is not for stage 1, not for stage 3, not for stage 4. This kind of characteristics which we want to look at stage 2 stocks only. Whatever non-negotiable criteria which I have explained. So maybe suppose if you filter all stocks at stage 2, you may get 300 to 400 stocks out of 5,000 listed companies which are trading in stage 2. But this kind of characteristics may appear in 5 stocks or 10 stocks or 2 stocks or 3 stocks on every day, on every week. So there we have to enter into the stock. That's where we will get money. That's where we will get huge profit. Because nobody is selling the stock, right? So actually, this kind of patterns, not only this is a characteristic of the this is a characteristic of the stocks. Sometimes we can see this kind of patterns also, bull flag, okay, and bull peanut. I tell you, descending channel, flat base or consolidation, cup and handle, and double bottom base. So because of time availability, right now time is 7:30. I can't able to explain every this one here. So I can say that these patterns are will form at stage 2 because of profit booking of very small institutions or retail investors. So here what happens while going up in stage 2, sometimes so profit booking, because of profit booking, because of a low supply, we want to look for lower supply at this level. We should not see higher supply. Because if air supply started, what happens? If some institution is coming for selling, they will not sell in one day. They may sell for months. They may sell for weeks. So that is the reason we don't want to see huge volumes at this level. We wants to see only lower volumes, and price also should be contracted, and price also should not be decreased by much. So these patterns we can see at stage two. Suppose stage 2 might be started 6 months back or 1 year back. Okay, still till this kind of patterns will form in between. That means somebody is taking some profits. Maybe this to form this kind of patterns, it may take 2 weeks or 3 weeks or 4 weeks or 1 month. So then we can buy at this level here. Here we can buy again at stage 2. Again, it have more probability to go up here. So this is called bull flag. This is a bull pennant. This is just volatility contraction only. Again, volatility contraction. I am telling that it is a simply volume is low. Volume supply is very little. Supplies are coming to the market by significant contraction in trading volume and significant quieter price action as the right side of the base develops. So we want demanding that our stock meet this criteria before improves the likelihood of that our stock is off from the public radar. Sorry. Okay. So is it clear to you? Next, descending channel. This is also volatile VCP only, volatility contraction pattern only. Some only few volume is coming to the market. We are not interested. We are not interested stocks which are passing through stage 2. When huge supply is coming to the market. That means stock is going down. At even stage 2, that stock we are not interested. Only 10% correction, 15% correction kind of stocks we are interested when it is in stage 2. That is a descending channel only. It is just a profit booking only with low volumes. We can buy here. Flat base, we can buy here at stage 2. Cup and handle, see. Cup and handle also we have to look at stage 2 only. That is where we are interested. All these patterns which we are looking here should be formed while in stage 2. This is very clear. It does not work in stage 3 or stage 4. It may work, but it will not give huge returns. I started analyzing only stocks which are in stage 2. This is cup and handle. Okay, it may be giving some 15-20% correction. It is slowly going up. Again here little handle is forming because of whoever entered here. Okay, they are sitting with losses. They are coming and selling here with very little volume. That means institutions will not sell. Even institutions bought here, they will not sell here. They will hold. But retailers are selling the stock. That's why it is a little going down. From here, no supply coming to the market. Again, it is going up here from here. So these patterns usually we can see at stage 2 only, not stage 3, not in stage 4. This is double bottom. In stage 2, what happens while going uptrend from here, some profit booking came. Again, it tried to reach upward. Again, somebody has got some fear. They are selling some stocks. Okay. So here almost weekends are gone. No sellers, only buyers. Calmly stock is going up. I really want you to understand these patterns. All the characters remain same. Is that in stage 2, whenever stock is giving correction, it should be corrected with very lower volumes. It should be corrected with very very little price. It should not correct more than 20% or 25%. It is better to correct to the extent minimum. But next one, IPOs. Just I am looking time. Now time is 7:34. Okay. In another 15 minutes, I will try to finish. Okay. Then we will have a question and answer session. Actually, here so many comments, chat box, some comments are there. Okay, I will go through later. So this is IPO. This is very interesting one. So many people know about Zomato, Paytm, Trade. So
sorry to disturb, speaker sir. If IPO is altogether different topic, then we can have question and answers for this till now, whatever happened. Then if time permits, we can go to IPO.
Okay. No
Because
problem.
we wanted it to be more interactive because so many people may have so many doubts
Okay, no problem.
What members, whoever want to speak, ask something, if they can unmute.
At least, Ravi Shankar sir, at least I should cover risk management. That is very most important. Okay.
Then okay, please go ahead.
I want 10 more minutes. Okay,
No,
I will
please,
explain.
Please
I
go
want
ahead, then we will
explain.
have a.
Just give me 10 minutes. Okay, I will finish it. So
Okay.
this is IPO. See, IPOs. Right. See, we should not apply for all IPOs which are going to listed in the stock exchanges. So allow primary base to develop. What is primary base to develop? Once stock is listed on the listing day or next day, stock may go up 30%, 40% or 45%. After what happened, some institutions come and sell that stock. Example, Paytm, Zomato, Corporate. Okay, so many companies are there. We should not apply for any IPO. We should not buy the stock on listing day. We should buy only after allowing primary base to develop. Primary base in this sense, all weekends should go out. All supply should come to the market. Let them go out. Let them sell and go. Then stock will break. Stock will give breakouts. Okay. So there we have interested. So generally what happens after listing, stock will give some after 1 week or 2 weeks huge corrections. Then we have to see whether stock is performing well or not. So suppose you assume Paytm, in case of Paytm, what happened? It is every day it is coming down only. It is not going up. Okay. So we have to see where stock is giving strong breakout, where we have to check whether institution is selling the stock or not. If institution not selling the stock, I mean, then definitely it will not come down, right? It will go up only. There we are much interested. Okay, and 8 to 10 years after IPO, generally stocks perform much more better in after listing. That means 8 to 10 years. We can look these kind of stocks, and stocks should be great fundamentals, and don't just buy what you know. So just you legend that company name. So that is the reason don't buy, and multiple buy points. What happened was stock once reaches the least resistance point. So if we are not buying at that point, we can buy with VCP patterns, volatility contraction patterns. So this very in summarized way, what I am trying to say. So we should not apply for any IPO. Let it listed. Then you see how institutions are dealing with that stock. Let them sell. Then you see. Okay, so don't just go and buy. That is the IPO slide. So due to time availability, I'm not explaining in detail. At least allow primary base to develop. Allow primary base. You see how institutions are reacting. Next, results, announcements, and news. So here, so before giving any company results, don't buy that stock because it will create huge volatility. It may hit stop loss also, and don't hold the position unless it is in profit. Suppose after purchasing share, maybe within a week or 2 weeks, company going to declare the results. Okay, by that time you don't hold the stock unless you are in profit. If you are some profit question of some 10% or 8%, you may hold that stock. But otherwise, you are into break even or in loss. Just sell the stock before announcing company results, and post the results. Observe market reaction, how market is taking. Once company declared the result, okay, whether market is taken positively or not, immediately first day maybe huge volatility. At least after 1 week or 2 weeks, you can see how institutions are reacting to that stock. Again, institutions are coming and selling huge, then you also should not hold that stock. Next, reaction to news, stock recommendation tips. So don't listen to news, don't listen to stock recommendation, don't listen to newspapers, tips and all. Okay, and everything which might be factored in the stock prices. Okay, so news and all don't listen. Just see stage 2 stocks and see proper consolidation. Once it is breaking from consolidation, just buy it with proper stop loss. Stock exchange filings, let them file stock exchange filings. We are not much interested what exactly happening in the company. We are interested in earnings growth, revenue growth, and stage 2 stocks and proper consolidation. Then sell rules. Sell risk when we have to sell the stock. So failed breakouts, no follow through buying. After we bought, what happened? No institution is coming and buying that stock. So then what? So price will not go anywhere. So something we thought wrong. We bought at stage 2 only at upper breaking from consolidation. But what happened? Nothing is moving. No institution is coming to that stock. So no follow through buying. Just leave that stock. Okay, don't hold the maximum. See for 1 month, then leave the stock. So I am trying to explain in terms of short term trading only. We may hold for a month, 2 months, or 3 months, 4 months. I am not interested to hold any stock for longer term because of we can't control this kind of environment. That current price is below 8% purchase price. Don't give chance to get a loss of more than 8%. Put very strict stop loss 8%. If we are keeping stop loss more than 80%, so very difficult to success in the stock market. So we should not get a loss when we are wrong. It is more than 8%. Sell off with huge volume. So we bought the stock at stage 2 only. Later, what happened? Some institutions are coming and selling. Some institutions are coming and selling with huge volumes. So that time, what will happen? Definitely, it will go down because institution will not sell in one day. They may sell for like weeks or months. Okay, that is the reason we don't want to hold that kind of stocks. See the volumes. Next, breaking down 20 MA, which was already explained. Relative strength rank down 3 consecutive lower days every preceding 3 days. So it is coming down with huge volumes. So and sometimes general market also weakness. That time also it is better to leave the stock. So discipline is very most important. So whenever stock is going down, okay, to breaking from 20 MA, just sell the stock. Don't think that okay, it is correction. See, what is this position? Is it correction? Is it not correction? It is almost death. So risk management. So what is pivot point means at stage 2, we have to buy the stock where proper consolidation with only contraction in the volume, contraction in the price. From breaking out from that stage, we have to buy. And next, progressive buying. Don't invest all money at a time. Just invest 25% of your capital. Then see whether you are getting profit or not. Whether you are in right thinking or not. If you are getting some profit, then you can increase your position. Then you can increase your position. Don't think that we have to invest entire money at one go. Some disturbance is coming. Can you put a mute? So next one, position sizing. Position sizing also most important. So we should not hold more than some 8 to 10 stocks. Okay, that is also most important point. Next, over trading. We should not do over trading. Whatever trades which we are going to take at stage 2 at proper consolidation. So we have to carefully analyze. Then we have to see. So margin play. We should not play. We should not do stock market with margin play. When we are getting good profits, then we may think. But when we are into losses, to recover that losses, don't borrow again. That is very risky proposition. Profit booking also most important. Stock will not go on daily basis up. Sometimes some profit booking also we have to do because any doubt you are getting that institution is coming and selling, that time stock may come down very high. So before that level, we have to do some profit booking. So I see mind-blowing math at 50% win rate without stop loss. So this is 20 trades. So his success rate is 50% only. So he did 20 trades. 10 trades are successful. 10 trades are unsuccessful. In 10 trades, this is green numbers are profitable. This red numbers are losses. Finally, he has invested 1,15,000. Sorry, he has invested 1 lakh rupees. He lost 60% of his capital. 60%. Only 40% capital is there. If you see this slide, same numbers. Green numbers are remain same, but red numbers are different. Here, given a stop loss of 8%. Whenever trade is going wrong, he's given a stop loss of 8%. Then what happened? So profit you can see here. Same trades, same companies, same 20 trades. Is it clear? Yeah. Same 20 trades, but what has happened? Green numbers remain same, only red numbers are changed. That means he is given a stop loss at 8%. Finally, he ended with good result. So practically 50% batting average is a very good. 50% success is very good when you use stop loss maximum of 8%. Ravishankar sir, thank you very much. I have finished the presentation in very fast track manner because of time. So now we can open for Q&A session.
Before I say formal vote of thanks, I'm requesting members to ask any questions if they have. They can unmute themselves and speak.
Yeah.
Anybody? See question and answers. No short box. Can you show filtering of stocks based on technical and fundamental?
Yeah, I will show you. I will show you.
Hmm. So, if no questions are there,
Yes, I'm trying to come out from this. Okay.
Mhm.
You want to? Once again. Yeah. What?
I'm getting so many personal messages with a lot of thanks for this wonderful session.
Okay. So this is yeah. Can I tell?
Please,
Okay.
please.
Yeah. See, this is the MarketSmith India website. Okay, I'm taking one stock. Any stock I can. Gujarat Fluorochem I take. Okay. Actually, this is paid subscription. Okay, I'm using to filtering stocks.
Take HDFC. Can you show that stock, please? HDFC Bank. Sir is asking.
HDFC.
HDFC Bank. One member asked.
HDFC Bank. HDFC Bank. Okay. So this is HDFC Bank. So here is getting loading. See, here earnings in MarketSmith India, we can able to identify very easily. EPS strength is 90. Here group rank is 71. Here I'm interested. Relative strength is 41. Okay, we are interested to involve into the stock where relative strength is more than 70. In this case, the relative strength is 41. We are not interested to buy the stock unless it is improved to 70. And at least the earnings are good. But I am with see one thing: buy with fundamentals, sell with. Buy with fundamentals plus technicals, sell with only technicals. While selling, we don't want to analyze more fundamentals. We may not get such time to take it. So that is the reason here. Stock is showing EPS is good based on this, but this moving average are still going up. 1 second. I will show you how to see. See number of funds. Number of funds is okay. Number of funds it is showing quarter on quarter 52%.
Your voice is breaking, sir, sometimes.
Something is going wrong. 1 second. Yes, this is estimates related. So here also we can see. First, let it improve. So I don't want to invest. I'm taking Tata Elxsi stock. Okay, Tata Elxsi. Okay. See here. Tata Elxsi performed very well. I think it is loading. I think internet connection is little slow. Okay. So in case of Tata Elxsi, EPS strength is 94, price strength is 67. Buyer demand is B, and the group rank is 119. So group rank is, I mean, at least we can able to manage. See, number of funds you see here. Number of funds, it is 560. It increased by 66%. Shares held by funds 7.09% has been increased. That means almost 1.21 crore. Earnings you see here. Earnings. In 2015, earnings are 16 rupees. 2288, 25 they are expecting, 114. Not companies expecting, some brokerage companies are expecting. So for analysis purpose, I am using this MarketSmith India. Readily, so much information is available. So that is the reason I want to show here. We can able to identify this is the Excel. Okay, in one slide I put it called RS line. Here RS line is showing downtrend. Okay, so we want RS line should be uptrend. Even though RS rating is 67, this blue line. So one can see this cursor here. This line should be at least uptrend for 2 to 3 weeks. This line is in downtrend. We are not much interested to buy the stock, even it is in stage 2. You see, this is the stage 2. This is stage 2. So all this is a Bible. This is at this level you can buy proper consolidation. So in stage 2, stock may give chance to enter. Maybe it may give 10 times or 15 times or 20 times to enter. Okay. So that point we have identify at stage 2. So Tata Elxsi stock given is so many times. Stage 2 proper tight contractions in the volume, proper tight contraction in the price. But at this level, the RS rating 67. Now one can see here very clearly RS rating 67. At least it should be a minimum 70 because it's not performing well. Compare it to peers. Okay, at least I want to see minimum 70 rank. Okay, but RS line means a very recent trend it is showing. It is not RS say this is the relative strength of RS. Okay, it is coming down. RS line is showing little down, but we want to see line should up. And one more thing I want to explain here. If indexes are trading, if indexes are Nifty 50 index or Nifty Next 50 or Bank Nifty indexes are trading below 20 EMA, we should be very careful to take any positions. If market is very weak, we should not deploy 100% capital. You may deploy maximum 25% of the capital. If index trading above key moving averages, 10 days moving average, 10 days environment is good, how is environment, whether it is profitable or not. Okay, just you put a little amount only, then check. Okay, how it is. If it is getting good profits, so then you can increase the number of stocks and you can increase the number of position sizing. Okay, yeah. Any doubts? So this is MarketSmith India. Okay, mostly I use this one. And trading, I use trading MarketSmith India. Yeah. Doubts?
Yeah, one member is asking. One doubt.
Yeah.
You can see stocks are priced based on forward estimates or PE, while fundamentals show past information. So we need to use stage 2 technical approach as mentioned by you.
Yes. See, while buying, we have to use fundamentals plus technicals. But in case of selling, we have to use only technicals, not fundamentals. What happened? We saw that Zoom stock, okay, or Yes Bank, or some other stocks which are going away from stage 3 to stage 4. First, technicals will give indication. See, whatever news is available in the market, only you people or I know very last. Institutions know very first stage itself. That is the reason we can see in technicals. All news is factored in the technicals. All news is factored in the volume and demand and supply. We should not wait for fundamentals to turn bad. We have to take a call based on technicals. How to sell, when to sell. Okay, that's when we can be able to protect our profit. We can able to protect our capital. If you are waiting for a fundamentals to turn bad, by that time stock might go down 80%, 90%, 99%. Nothing will there to sell. Okay, we may get 1 rupee, 2 rupee. So don't think that fundamentals are strong. Don't attach with any stock, or don't listen to anybody. Just see the stock. If the stock is holding 20 EMA, okay, then good. If it is not holding, just blindly sell it. After 1 month or after 2 months, you see what is the stock position. By that time, it might be come down to 50% or 60 or 70%. So fundamentals may take so much time to give indication after before that everything happen in the stock market. Okay, so not required our news. Generally, I never read newspapers. I never read business information. I never see any social media post. I only see how stock is performing, how institutions are behaving, how earnings are improving. That is what I want to see. I don't want to waste so much time on newspapers and all those things. Okay, I never read about business papers. Yeah.
Thank you, sir. Thank you. Now I request Deepak Lata, Chairman of the branch, to give his closing remarks, sir.
Thank you, sir. A very wonderful session. In fact, there are few sessions which are very
Yes, sir.
which catches the attention of the audience in full from starting to end. So I should say, frankly, this was one of the session I like personally because it is my subject also, and the way you have carried forward, giving the full details, because we see speakers generally give only the overall picture but not the tricks. I should also thank Ravi for recommending such a speaker to Hyderabad branch. And sure, I would only say, please keep on coming to Hyderabad, and whenever you are into Hyderabad next time, we'll keep it physical so that
Yes.
members gets more offline information also, because I know in a CP program we cannot disclose many information which may be informal also, but definitely as you are based on your experience and strategy, there may be certain information which as a practical strategy you would like to share. I am definitely happy and I'm a fan of you, sir. Thank you.
Thank you, sir. Thank you. Because of time available, because of time constraint, I can't able to go through all things because it requires
this is a topic, sir, this is a topic relating to money and finance. It can go 2 weeks through a week also. Every script we can do in detail analysis.
I learned this by by spending almost thousands of hours. Okay, I can't able to tell in 2 hours. Okay.
Correct. Thank you, sir. Over to Secretary.
Thank you, sir. Thank you very much, sir, for giving this wonderful opportunity, and thank you for all participants. Okay, listen very patiently. I don't know. Okay, who all understand this session, but okay.
No, thank you so much, Chairman sir, for accepting the speaker when I recommended. Because even I was skeptical because this topic is very scary topic. Though he is my friend, I was little skeptical how he will handle this issue. But I believe once I went to audit in Vijayawada, he told me that his success story and all. But I did not believe till he shown me his tax P&L by entering login password by myself. Then it was very shocking to know that he has performed, I think, around 500 plus percentage profit he got. Then only I believe that he has earned some knowledge and he can show real wisdom. He can share real wisdom in this topic. That's the reason I recommended. Thank you so much, Trasu. You have proved me right by bringing you to Hyderabad audience. I am getting a lot of personal messages, though many members are not responding in the groups. Thank you so much. This, as you told, this is all about money, and we have to have a lot of discipline and wisdom to save our capital and have some profits. So thank you so much. If members are seeking, some members are asking that we have to have more sessions like this. If as Chairman sir told, if some members are really interested to have physical seminars, we can have 1 day or 2 day workshop also, because you can show live and practical about the real techniques and all. Those who are really interested in the topic, they can join. If it is a workshop model, we will plan. If members are seeking it, we will plan, sir. Santosh, can you please share virtual memento to Trasu? Thank you from the bottom of my heart, Trasu.
Thank you, Ravi. Thank you so much.
Valuable time.
Thank you.
We'll have more such sessions in future.
Yeah.
Thank you so much, sir, Deepak sir, and we are eagerly waiting for another interesting seminar, which is physical in nature, on 18th about foreign opportunities, global opportunities, by one more renowned speaker.